All right, before we get started, we have to go through the required risk disclosure. Just a heads up, this is all for informational and research purposes only. It is not investment advice. You know, investing has significant risks, and that includes potentially losing your principal. So just remember that all the strategies and market views are for reference, and you should always make your own investment decisions independently. And of course, past performance doesn't tell you anything about future results.
Okay, let's dive in. We're breaking down a U.S. market analysis from Friday, March 13th, 2026. Things on the ground are moving incredibly fast, and the situation is getting more complex by the hour, so let's get right to it.
So here's our game plan. We're going to kick things off with the single biggest thing driving risk right now. That's the geopolitical situation in the Strait of Hormuz. Then we'll see how that's hitting the energy market, pull back to look at the big macro picture, which is now confirming stagflation, and then we're going deep into the market's internal plumbing to talk technicals and gamma risk. After that, we'll look at some of the index heavyweights that are really feeling the pressure before we tie it all together with portfolio strategy.
First up, let's tackle the absolute core of the market's volatility. We're talking about geopolitical risk. The tensions over in the Middle East, specifically in the Strait of Hormuz, have just moved into a much more direct and, frankly, dangerous phase.
Okay, so what's really happening here? Well, according to the Pentagon, CENTCOM put in a request, and it's been approved. They are deploying a Marine Expeditionary Unit. And we're talking about a serious force here, up to 2,500 elite Marines. Their objective, it's crystal clear, to forcefully secure control of the strait and get that energy corridor back open for safe passage. This is a major, major military escalation.
So, this brings us to a really crucial idea, the strategic quagmire. You see, the market might be pricing this in as a quick little operation, in and out. But this analysis is warning that we could be looking at a long-term military presence. And if that happens, it means the higher risk premium we're seeing in the market isn't just a temporary spike, it's the new normal.
Okay, now let's follow the ripple effects from that geopolitical tension straight into the energy market. Because in this new environment, energy isn't just a simple commodity anymore, priced by supply and demand. No. It's now being used as a strategic tool, a weapon really, in this whole great power competition.
And this chart just lays out the pressure perfectly. Right now, the crude oil market is already short 6.5 million barrels a day. JP Morgan just came out and revised its forecast for the shortfall up to a really staggering 12 million barrels. But you know what the most important number on this slide is? It's that third bar. The trigger for systemic demand destruction is estimated to be just 7 million barrels. We are right on the edge.
This quote, wow, it really cuts to the heart of the economic pain. All the panic buying we're seeing at the pump, the stockpiling, what's really happening is a massive forced transfer of wealth. It's moving from the pockets of ordinary households directly onto the balance sheets of the big energy companies. And that just throws the entire economy even further out of whack.
All right, let's pull the lens back from energy for a second and look at the big picture. The latest batch of U.S. economic data, well, it's painting a textbook picture of stagflation. Growth is hitting a wall, but inflation is proving to be incredibly sticky.
Let's just walk through this data because it tells a story. First, core PC inflation is sticking at 3.1%. That pretty much slams the door shut on any hope for the Fed to start easing. Second, Q4 GDP got revised down to a measly 0.7%. That's a flashing red light for stagflation right there. Third, job openings ticked back up, which means the labor market is still tight, and that's going to keep wages from cooling down. And finally, consumer sentiment has absolutely cratered to 55.5, just completely wiped out by all this geopolitical fear.
So now, let's shift gears and look at the market's internal plumbing, because while the fundamental story is pretty bleak, the way the market is positioned is so one-sided, so bearish, that it actually creates a really weird kind of risk, the risk of a violent snapback rally.
Okay. So here's the number everyone is watching for the S&P 500. The big test is the 200-day moving average, right around 6,600. But the real line in the sand, the make-or-break level, is 6,570. If we get a decisive close below that, it could unleash a much, much deeper wave of selling.
And here's why that number is so important. It's because of a technical concept called deep negative gamma. The best way to think about it is like a snowball rolling downhill. As the market falls towards that key level, the big dealers, the ones who sold insurance on the market, are mechanically forced to sell stocks to hedge themselves. And that forced selling just adds more downward pressure, which can create what's called a liquidity vacuum, a situation where there are suddenly no buyers left.
This slide lays out that chain reaction perfectly. It starts with the index getting close to 6,570. That pushes the dealers into that dangerous negative gamma zone. Then,
They are forced to sell more and more as the market falls, and boom, you get a liquidity vacuum where prices can drop scary fast.
But, and this is a huge but, here's the twist. Just look at how lopsided and crowded this bearish trade has become. The daily RSI is screaming oversold down at 21.4. Goldman's data is showing a near-record surge in short positions. We're talking about the 97th percentile for bearish bets. The market is basically a coiled spring, and the analysis suggests that just one piece of good news could trigger a massive, painful short squeeze for anyone betting against the market.
Now let's zoom in a bit on some of the biggest, most important stocks in the index. Because during these big macro dislocations, the individual stories and the technical breaks in these heavyweight names can really pour gasoline on the fire of overall market sentiment.
So let's put two of these giants, Meta and Tesla, side by side. For Meta, the issue is fundamental. A delay in their big AI model, Avocado, is making the market question their whole AI leader narrative. But for Tesla, it's a pure technical breakdown. The stock just sliced through a key support level, and the analysis here is blunt. Those price levels tied to Elon Musk's stock purchases, that's purely psychological support, it's not structural. The real technical floor could be much, much lower.
Okay, let's pull all these threads together in our final section on portfolio management. What we're seeing is the economic slowdown and this widening gap in the K-shaped recovery, putting direct, tangible pressure on the market's underlying structure.
And what's so fascinating here is this one number, 2%. That's the rough increase in the rate of people taking early withdrawals from their 401ks. Think about what that means. This isn't big institutions selling. This is forced liquidation by regular households who are under financial stress. It's a constant underlying drag on the entire index that has absolutely nothing to do with company fundamentals. So in this kind of environment, how do you play defense? Well, here are the specific chess moves being made. For a name like Microsoft, it's a waiting game. You only add on a big dip. TSMC and Google, you just hold steady. AMD is getting downgraded, with a plan to get out of the position entirely. The plan to add to TRV is still a go, but the add target for ISRG is now completely off the table because of its high valuation.
And that brings us to the bottom line for the immediate future. It really all comes down to this. The single focal point for the entire market heading into the weekend is what happens with navigation through the Strait of Hormuz. That one variable is going to be what drives the market open next week, period.
And if we look past the immediate crisis, the medium-term picture is pretty clear. A stagflation regime has now taken hold. It's squeezing the economy from both sides with weak growth and stubborn inflation. And the inevitable result of that? Tangible damage to corporate earnings is now viewed as highly likely.
And this all leaves us with the central conflict facing every single investor right now. It really boils down to this critical question. You have a market that is positioned for a crash, just coiled for a potential squeeze, clashing with a macroeconomic reality of confirmed stagflation. In that environment, what's the optimal way to structure a portfolio to protect against the tail risk from either side? That's the crucial question for the days ahead.